which is weird. It's kind of the opposite when I was working for the man.
Speaking about income generating assets, what is your view on real estate? Do you see it useful as a stable source of cash flow, or maybe even a diversifier in retirement? I'm asking because in Romania, I think most of the people invest their money into real estate.
In real estate.
It's also easy to invest a lump sum like this because you don't care
Yeah,
about
sure.
volatility. And I think less than 1% of Romanians invest on the stock market. They see this as a risky thing, as something like gambling, you know. And it actually is if you invest in individual stocks and not broadly diversified ETFs. We even have
That's also fallacy, I think.
we even have a
I think
blogger here in Romania. I think you also know him, Money Caravan, who bought I think 10 or 20 flats in Bucharest, and he's very well known for his real estate investing.
okay.
I don't like this because it's too concentrated and illiquid asset, but there are many people who prefer it. What do you think about it?
Okay, there are many aspects to this, of course. One is investing in real estate is not a passive investment strategy. That's a job. That's a job. If you have 20 flats, it's a job, but it's usually a job that people like. So I have few friends, one from Greece, and another one I think it's Romanian, and he has 3-4 flats in Bucharest, by the way. So maybe it's not the same person we talking about. So people who invest in real estate this way, they usually love it, and they love to go for bargain, to love to go and take a look at flats for sale, blah blah blah. So that's a job. If you like it, go for it. If you don't like it, I don't think that's going to be a nice idea. First, you need to be local. You cannot just buy a flat somewhere in the world and then assume someone will manage it for you. Or, yeah, you can delegate, but it's expensive. So, yes, you need to like it. You need to be local where you have the flats, or find an arrangement that makes sense. And, okay, so those are the prerequisites. You need to like it and you need to be local. Then there are, of course, the risks. There are many, many risks. First of all, there is like liquidity risk. In Italy, during COVID, I've read some statistics that say like 49% of tenants stopped paying rent. But even outside of COVID, I think in Italy, the baseline is like 28%. I mean, if you rent to a random person, there is more than 1 in 4 chances that at one point they stop paying the rent, and then you need to go through all the pain of getting back the flat, which will take years, and damages, uncovered damages. So you need to be prepared for a lot of things. Of course, there are sectors that works better. Like if you buy a luxury flat, that seems to work better. But also the prices for luxury flat is skyrocketing. So if then the town goes out of fashion, you will lose a lot of money instantly. But also renting to students, or like house hacking, like buying a house and then splitting in several units. There is a lot of activity. But yes, it needs to be considered a job. I don't know. I want to do that as a job.
Seems like a lot of work for an investor.
Yes, a lot of work. And then you say, like in Romania, 97% of people are homeowners. So if you buy 20 flats in Bucharest, who are you going to rent them to? The math doesn't match. There's not a lot of demand for renting. Then, of course, you have a lot of costs. You have a lot of unrecoverable costs anyway, fixed expenses. So the asset is not liquid. There are many disadvantages. But if you can get 10% pre-tax expected yield, good for you.
I think it's all about opportunity cost after all, but you have to take into account all these risks. There are huge idiosyncratic risks for managing a property, and also a lot of work involved with it. Also, very illiquid asset class. So if you ever need money,
there is one aspect people usually don't talk about, is that like bonds, when rates go down, those assets inflate a lot. So now you are going to pay a lot to buy a flat because people they yearn for passive income, for kind of yield. So now everybody's willing to accept a 5% return. If tomorrow the other asset class will have a higher expected return, like bond rates go up, people would drop investing in the stock market, in the real estate market, and so you will lose a lot of money on your property. And then, since it's a leverage investment, usually, like you put 20% and you pay 80% on mortgage, if the house loses 20%, your down payment goes to zero. You have zero equity in the flat. So it's very risky. Now everywhere I know, house prices increase. So whoever is looking to the past, they will tell you, hey, look, I got 10% yield plus my house appreciated 2x. Mm-hmm. Oh, good for you. You've been riding the way up while the interest rate went down. What if now things revert?
Yeah, but people usually extrapolate past results into the future,
and then it's forever in the future. Yes, of course. I bought a flat in 2010 in Italy, a small one. I was renting in Milan. I was paying a high rent, so I looked for the cheapest flat around in outside of Milan, and I paid like 100,000 euros for a flat, which was like, I thought it was impossible for the flat price to go down. But then I sold it in 2019 for 75,000. So it went down. So it can go down. So I'm a first-hand experience that after 10 years, my flat went down. If I invested the same money in the stock market from 2010 to 2019, those 100,000 would have become 350,000 probably. So yes.
It can go down, but you don't know because there is no secondary market, and people feel comfortable with this. They think about, I don't care about the home price. I just want to receive a monthly cash flow, passive income, and there is also this.
Yeah, but it's the same fallacy, same dividend fallacy. You want to receive a passive income, but what if your the value of the equity you own went down? So if tomorrow you need to liquidate, you are subject to the actual value of your asset. So that's part of your financials. You cannot pretend it doesn't exist. So basically, you say, okay, I have good cash flow, but then maybe one day, in Switzerland, banks can call you and tell you that your house has lost more than 20% value based on their numbers, and so they're not okay with having 100% of the equity, so they kind of issue a margin call on your flat. That's not a nice situation where to be.
This was always an argument for real estate, that you cannot get into margin call as compared to levering a stock portfolio.
In Switzerland, you can. Because in Switzerland you never repay the mortgage. You only repay a small portion. So in Switzerland, you have to pay usually 20% as a down payment. That can be 10%, and 10% can be pension asset pledged. But then another 15% you need to repay before you reach pension age. And then the remaining 65% you can keep on forever, only paying interest and keep on forever. So at one point, if the house halves its price, the bank is not happy to having an outstanding credit larger than the value of the asset.
Giorgio, given expensive equity market valuations, which is your view on a CAPE-based tactical asset allocation?
That's what I do. I have a formula that tells me how much percentage of stocks should I own and which percentage of bonds, and it's based on CAPE, based on cyclically adjusted price to earnings. I don't claim it to be like a perfect formula. I've actually found many people who disagree with that. I think it makes me sleep better at night. So if the market is highly priced, and I define highly priced as a high CAPE, I prefer to stay low in stocks. And if the market is underpriced, by some definition, but not everybody would agree that having a a low cap, it means that the market's underpriced, I will be more aggressive into the market. So it's a kind of roughly 60-40, but it goes 50-50, 40-60 if the market is overpriced, and it goes even 70-30, 80-20 if the market is underpriced. So that's my strategy.
But the equity allocation remains in a global index fund, or also moves into undervalued regions, like, I don't know, emerging markets, for instance?
No, my philosophy is usually to be at least 80% spread across all the world based on market cap, and then I allow myself to have like a couple of bets on individual regions, but I'm not betting at the moment. So at the moment I'm mostly market cap weighted, but I have a small bet in the value factor. So I'm a small bet. I know value stocks, they are underperforming since the last 20 years compared to growth and momentum factors, but I see value factor as the closest way to a stable company that sells goods and then gives you like a stable cash flow. So I'm like 50% on like all world, all cap, whatever, as global as I can, and 50% all world, but value factor. So I'm overexposed to value, which usually correlates with high dividend, but not necessarily. That's a different thing. So I'm getting this strategy is a bit inefficient in Switzerland, because in Switzerland the profits are taxed while the capital gain is not taxed. So in Switzerland you are incentivized to all the growth stocks essentially. But I like it this way, even though it's a bit inefficient, and even though probably I'm underperforming the global market. But in the last month, the Nasdaq has fallen, while my value stocks, they went up even during the last couple of months of not very nice market. I like it more. It seems to me that they have lower volatility, and maybe they're more resistant to like a bubble exploding.
That's true. Larry Swedrow has now switched all in to value. The second time after 2000s, when he made his first tactical asset allocation, he maintained his equity allocation the same, but moved all in value.
Okay. I might move more to value. I think I'm 50% value and 50% everything. So I might be more intentional and be more value and less not value.
So this Cape-based asset allocation you mentioned before would be like your risk management overlay strategy that you use right now to prevent catastrophic losses in this market environment? And if yes, can you explain us how this works, this rule?
Well, I should put more effort into find a better way to prevent catastrophic losses. I'm still exposed to market risk. I'm still more or less 50% bond, 50% stocks, and bonds are sucking these days. So I'm not really happy of my asset allocation. I'm studying a bit into tail hedging, which is like Nassim Taleb thing, like having a small fraction in something that goes very up if things go south, like having put options, buying put options on the. There is some strategy to protect you from tail events, but I'm not doing that. I'm just studying, and yes. So to avoid catastrophic losses, I'd rather reduce the stock allocation in these days. I'm thinking about moving like even to 40% stocks. The problem is that there is no alternative. That's the main problem. What else would you do with money? What else would you do with high inflation coming? Well, bonds are getting a bit more appealing because the rates are going up, but also inflation is. So I don't have a great strategy. I'm just there for the long term. So I tell myself, hey, sooner or later something's gonna go down. It's impossible to time it. We only know that the current environment predicts a lower expected returns for the next 10 years.
Yeah.
Which means it can go like slowly up, or it can go up, and then crash, or crash tomorrow and then get up. Like Bank of America and Vanguard recent studies say that it's 0% real return or 1% real return for the next 10 years based on inflation rate, expected inflation and expected returns. I mean, there's no alternative. You cannot keep money in cash under the mattress. I need to accept high volatility for low return. I don't know if anybody has a better solution. I'm willing to listen.
I think cash is useful on the short term to use it maybe as a hedging for market downturns. But if you think on the very long term, it offers deeply negative returns, so not very helpful. And also bonds, the same thing. Negative real returns, not very helpful for diversification.
But you cannot, I mean, you want to go 100% stocks with millions and consider yourself partially retired. It's tough.
Yeah, what I'm doing right now, since I'm still young and have, let's say, a long-term time horizon, I'm mostly invested in emerging markets because I understand that they can go down a lot, and especially if the currency depreciates against the dollar. So this does not protect me from drawdowns, but it might protect me from long-term returns that are now, let's say, questionable for developed markets. So
yes, of course, and this is for large cap.
This is a low turnover strategy, but not very good for tail risk protection. However, there is the alternative that we have, which I'm not using yet, of a momentum tactical asset allocation based on trend following. What do you think about it?
Wow. I'm very, I don't know. With my wealth growing, I'm learning more about my risk appetite. I'm learning more about myself. I'm facing situations I was not used to. I didn't grow up in a rich family and blah, blah, blah. So I discovered that I get more anxious when things go well, which is a bit, what? But I kind of rage quit the stock market a couple of times, but at the historical maximum. I said, hey, this cannot go up. It cannot keep going up. While when the market crashed in March 2020, I was there buying. So I know it's a logical fallacy, but when something went up, I have hard time jumping on the bandwagon. I think there's already given the returns, the expected return. So I don't like momentum following. But that's just me. I should probably just study more and maybe accept it. And it's usually momentum. It goes very, very well during like pre-bubble, during a bubble era, before the bubble explodes. And I'm not sure it performed well during a bear market. I mean, it seems to me like amplifying your volatility with not extra expected return. But I'm sure the factor investing theory would prove me wrong.
Actually, in a 2017 article named Reducing Sequence Risk Using Trend Following and the Cape Ratio, the authors found that for controlling tail risk, the choice seems to be between derivatives, according to Milewski and Posner, and portfolio timing adjustments into and out of cash. And there is also a paper that shows that if you used trend following for S&P 500 in retirement, it boosts your safe withdrawal rate from 2.95% for an all equity portfolio to more than 5%, because what it does is that it reduces this drawdown. So maybe not improving a lot the absolute returns on the long term, but what matters for emotional human beings like us is that you don't see all that devastating loss in your portfolio, because we all say on a bull market, buy and hold, don't care about what the market does, but when it actually crashes, you don't feel good about it. I think Matt Faber says that Um, what it matters is what happens after more than a 20% decline. So the first 5-10%, you don't care about it. But when it reaches 20%, 30%, 40%, 50%, you become anxious seeing.
Well, luckily for me, I've experienced only like the first huge drawdown has been in the end of 2018 with a minus 20% in Q4 2018. Then, of course, in 2020, we got a minus 34%. But I was like less invested. So I don't know what would happen in my brain if I see my portfolio losing 50%. I think what actually matters is what's your cash flow at that time.
Mhm.
If you are in a positive cash flow phase, that's not a huge deal. If you are early retired, if you are retired and then your asset halves, I don't know how I would feel about that. If you are still generating income and the assets halves, you can see that as a buying opportunity. You still have cash flow and you can fix with that. But of course, I only want to maximize. I only want to maximize the safe withdrawal rate. So I want to minimize. I want to be protected against sequence of return risk. I don't care about having extra fantastic return. What I'm doing to protect me a bit about that is that I try to also do some options trading. I wouldn't call trading. I usually do covered calls and cash covered put. Like the put, also Carsten does that. I learned it from his blog. So that reduces cost basis. That actually gives you a small boost when things go south. And that probably should, I didn't run the numbers, but increase the safe withdrawal rate, the acceptable safe withdrawal rate.
By the
But
way,
it's not like a life-changing strategy. It's just maybe a 0.2, 0.3% boost in the safe withdrawal rate.
By the way, which is your default safe withdrawal rate in this environment? And do you use any dynamic spending rules like Carsten Jeske suggests?
Interesting. Well, at the moment I'm not retired, so I'm generating income. I'm focused on being cash flow positive this year in 2022. In 2021, I've reached 60% safe withdrawal, 60% saving rate. Even though I was not working at Google, I've been partially self-employed, so I'm doing great. 2022, I'm finally only working on my own projects, so I'm focusing on being cash flow positive, which so far. Maybe I'm 10% below, minus 10% saving rate. So that's my first focus. I kind of stopped thinking about an absolute value for safe withdrawal rate because I think that constant dollar spending is a fallacy. Like the constant dollar spending strategy is like a huge fallacy. Nobody decide what's going to be their yearly allowance and then adjust it for inflation. There are many things about it. One of the best articles about this is early retirement now. You are a pension fund of one. That's called this. One of the safe withdrawal rate series part. I would love to discuss with Carsten about this. And it says that you need to protect yourself against the very high, the very low probability, but still likely to happen that you maybe live a long life, while pension funds can work on the aggregate, so they can give you returns based on the distribution of the population. So essentially, I don't think spending a constant amount for the rest of your life is a realistic scenario for anyone. Having said that, I think the best solution is to do like what a recent Vanguard study said. It's like a floor and ceiling strategy. So if the markets went well, you increase your spending by X. If it goes bad, you don't increase or you even decrease. So that might be the best solution. With that situation, you can really start with 4% and then adjust based on time. Or else, if I had to pick a safe withdrawal rate for the constant dollar spending scenario, I wouldn't go above 3%. I would say below 3%. And knowing that I need to have extra margin of safety, like maybe expecting a state pension and not accounting in my net worth, or ability to generate some income.
But do you prefer these discretionary rules of using guardrails?
I prefer yes. I prefer to define a budget and then see how the market goes, and then decide what's the budget for the next year based on that. What's the budget that our portfolio can sustain? Then, if I want to spend more, I need to generate that income.
So you prefer to have this flexibility, let's say, when the market goes down, and not think, let's say, in those probability-based approach.
I'm a very anxious person. I think, I've never been in that situation. Like I'm retired, I'm using my portfolio, then after 10 years something happened. I've never been there. But I know for sure that for me, I'm an accumulator. So I don't see myself like stopping generating money and then seeing my wealth decline. That would be, I don't know, a painful experience. So I prefer to tell myself that I have a strategy that takes into account a lot of flexibility, even though flexibility is a myth. But I prefer to do that, to sit down and decide, okay, this year I'm going to allow myself to extract X amount of dollars from my wealth. And then if I want to spend more, I need to work for that. If I'm spending less, okay, pat on the back and then put the extra money back into the system.
What about the other risk we can have in retirement? Because we usually use safe withdrawal rates for the worst case scenario. But what happens if we get a lot of money and we don't have time to consume all of it? How do you protect from this risk?
I see that as a very minor risk. I'm actually, if I would die with 10 millions, I think I can do a lot of things after I'm dead with this money. I'm not talking about anything which is religious or reincarnation. I'm thinking about, I have 3 daughters. I want to give her something. I might want to donate to some good cause. I actually think that the most efficient way to give is to make your money accumulate and compound better in my hand, and then give a lot of money at the end. So for me, there's no risk of dying with a lot of money, unless I had to make a lot of sacrifice. Like, I don't know, let's say I decide to cut my spending below the threshold that I think it's suffering, and then dying with millions, that would be stupid. So, but as I say, we come back to the beginning where I tell you that I don't have much needs. So if I can cover my expenses, that's okay. If I will die with billions, that's good for someone else.